So let's talk about debt settlement, debt consolidation, and credit repair. So debt settlement. So how does debt settlement work, or what is debt settlement? So debt settlement is basically where an individual. Let's talk more about a debt settlement program. So there are debt settlement programs, debt settlement companies that are out there, and what they do is they'll take all your outstanding unsecured debt, so non-collateralized debt. They don't do mortgages, they don't do auto. I mean, some of them probably can. I haven't really looked into it in a while, but majority will do unsecured type of debt, past due credit cards, current credit cards, medical bills, things that are non-collateralized. What they'll do is they'll put the total debt amount into a program, and the company would work with the creditors on behalf of the client to negotiate for a lower amount on principal and interest total, right? So let's say a client owes a credit card $10,000, right? They'll work with that credit card company or the collection agency, whoever it may be, to get them to agree to take less, right? Typically between 30 to 50 cents on the dollar, okay? And the monthly payments that an individual would be making towards this program typically are held in a non-interest bearing escrow account, right? Usually like a special purpose account they set up that's where the monthly payments are going into. They're not going directly to the creditors. They're going into this non-interest bearing escrow account where the balances will build and build and build to where there'll be enough in this interest bearing or this non-interest bearing account to where that company, as they're negotiating for settlement with with the client's creditors, what they have a creditor willing to accept less, and the client's accrual, balance is there where it needs to be to fulfill that offer. Then that's when the actual settlement will take place. So how does that settlement affect credit, right? How does it affect credit? Well, for someone who is current on their bills, right? They're making monthly payments to their credit card companies each and every month, but they're looking at debt settlement as an option because they're just realizing I'm never going to get out of this. It's going to take me 30 years to pay off my debt this way, and there has to be a better way. There has to be an easier way. So for someone who is current, meaning that they're up to date on all their monthly debt obligations with credit card companies and so on and so forth, in order for one of their creditors to even think and be willing to take less, there has to be a reason. There has to be a motivator behind all of that. And for creditors, that motivator to take less is normally connected to or correlated with the fact that they haven't received any payment for 90 or even 6 months, right? So up until that point, the creditor wants the monthly payments. They want they want the client paying the account directly over time, because in the long run, the credit card company stands to make more that way, right? The bank's going to make much more that way in the long run. So, of course, a credit card company or a bank is always going to want 100% payback plus interest, right? That's where they make their money. In debt settlement, because they're taking less, typically 30, 40, 50 cents on the dollar, there has to be a motivator that would even allow them to consider taking less. And typically that motivator is they have not been receiving payment for a period of time, 3 months, 6 months, maybe a year. Okay. So how does this affect the credit? Well, if someone is current, if someone's making their monthly payments on an ongoing basis, then knowing that fact right there, okay, that means that individual has to stop paying their credit card companies directly and start paying into that non-interest bearing escrow account. Okay. So their credit will be impacted because, as we know, when you stop paying your credit card companies, you're going to go 30 days delinquent, then 60 days delinquent, then 90 days delinquent, so on and so forth. Obviously, most of the damage happens in the first 90 days, the first 30, 60, 90-day derogatory remarks that get reported. That's where most of the damage is done. So someone could have, someone who has maxed out credit cards, perfect payment history, they're probably somewhere in the neighborhood of about, a 680, maybe 700, low 700 score, probably right in there. And once they let these accounts go, they're going to go from high sixes really to low fives, probably high fours in a matter of 90 days. So that's the impact that debt settlement program will have. Why would someone want to do it? Well, because like I said earlier, they're less concerned about the credit. They're more concerned about the amount of money that's going out each and every month, and the fact that their credit card balances aren't really moving that much. It's going to take them forever. So these are clients, or these are individuals that have reached a certain point where they're just like, I need something. I need to do something else. This is not working. What about your credit? I don't even care about my credit right now. Like I got a house, whatever. I don't care for it. I just need to get out of this debt, right? It's not getting anywhere. Another thing that could happen in the debt settlement program, I'm going to be careful for, or not us, but clients need to be careful for, consumers need to be careful for more specifically, is that period of time that there is non-payment, right? There is non-payment going on until a settlement's been reached. During that process, a creditor or even a third-party debt collector, may consider possible litigation, right? As a means to, as an avenue to collect the debt, right? Obviously, debt collectors usually don't want to go that route, but if they feel like there's no other option here, like the individual is not really keeping an open line of communication, we haven't received payment, there's really nothing, there's nothing promising that looks like it's going to happen here with this account. The creditor or the debt collector may want to pursue litigation. And so that's one thing to keep in mind. For a good debt settlement company will have a department or a process for this. So that's debt settlement. That's how that works. Debt consolidation, we'll talk about debt consolidation, the program versus loan, the difference between the two. So in the debt consolidation program, similar to debt settlement, the only difference is in the debt consolidation program, the monthly payments are actually being dispersed to the creditors. So a lot of these organizations, a lot of these debt consolidation programs are nonprofit based. And so they do take what's called like maybe an admin kind of fee for the work. They don't, it's not considered a profit. It's just an admin fee to run the program. A consumer is going to pay their full balance back, right? They usually would negotiate to lower the interest rate down. So let's say you have like a credit card that was like at 29% interest. If you go into the debt consolidation program, they close out the account for one, and two, you'll get the lower rate, which is maybe 14%, maybe 9%. Interest. So you're still paying back some interest. You're just paying that at a reduced amount. The accounts are closed, so you can't use them anymore. And the monthly payment that you are paying on the program is actually dispersed to the creditors each and every month. How this impacts your credit score is from the account closure, right? So if you've had an account open for 10 years, now it's finally closed, all that history is lost, as we talked about before on closing accounts. Also, on credit report, many times on the actual trade line, it'll say account paid by third party or third party intervention. That's on a credit report. While that comment doesn't have bearing to the score directly, depending on who's looking at the report, depending on what kind of loan you may be applying for in the future, that may be something to where you don't want to have on the report, because it does show that obviously you stop paying the credit card companies direct yourself, had to have a third party step in and intervene. As far as like a major score drop compared to debt settlement, you're probably not going to see a major score drop because you're not going delinquent. You're not hitting that 30, 60, 90-day delinquent marks. You are hitting, you are actually closing the accounts out. So the accounts do have to be closed. So that's going to be the drawback you have when it comes to your score. Now we're talking about debt consolidation loans. Well, basically to get a debt consolidation loan that is score driven, typically companies that provide consolidation loans, they usually want to see like right around the 620 credit score or higher. The loan is used to pay off your credit cards or any of your unsecured debts or whatever debts you want to pay off, and then you're paying back the new loan. That has a lesser of an impact compared to a debt consolidation program, because your accounts are not going to be closed out. You can keep your accounts open. You still have control over that. You're just borrowing money, basically robbing Peter to pay Paul, you like to say, the cliche phrase you like to say, and you're paying off your unsecured debts to be able to do that. And so the new installment loan on the credit report will have some sort of adverse effect of the score. Not as severe as that settlement program, but it'll have some adverse effect of the score. And the tricky part with debt consolidation loans is if you paid off your credit cards, but you haven't really cured the problem, right? The spending habits, or haven't put yourself on a budget, you could easily increase your debt load. You can dig yourself a bigger hole here, because you have a loan to pay off your credit cards. Now you have credit cards that have all this available credit. You find yourself in a pinch. You may start using these credit cards again, and before you know it, you have this loan that you've been paying off to pay off the balance on the credit cards you had previously, and now you have a new balance, new updated balance on credit cards because you've been using them. So it could be kind of productive sometimes. You got to be very careful and get into consolidation law, you want to make sure that you put yourself a budget, make sure you decrease your expenses, cut back on your spending. Really refrain from using the credit cards. Don't close them, but maybe cut them up, maybe get rid of them to just kind of reduce the likelihood of using them to avoid racking up more debt. So that's going to be the difference there on debt consolidation loan versus debt consolidation program. And then there's credit repair. That's us. So obviously our program, credit repair program, doesn't have anything to do with paying back debt. It has everything to do with how inaccurate items are reported in the report, whether they be violations of the Fair Credit Reporting Act, whether it be debt collectors that are violating the Fair Debt Collection Practices Act because they're collecting on debts that are invalid or have been invalidated. Or you're also dealing with Metro 2 compliance issues, right, in terms of how the items are being reported. It has everything to do with the accuracy of how the accounts are being reported. It has everything to do with the Fair Credit Reporting Act, with the Fair Debt Collection Practices Act, with Metro 2 data compliance. It has nothing to do with the debt. Debt and credit reporting are two separate things. Okay, so I want to throw that out there, that if anyone has, and consumers can have this in their mind if they sign up for credit repair and they get things deleted, that my debt goes away. My debt's also been taken care of. And that's not true. The reporting has been dealt with, but the actual debt obligation, that's still intact. That still exists, unless, of course, Eric or Sherry were able to get the debt collector to also not only delete, but to invalidate the debt and to step away from the debt. But when it comes to the majority of the time, it's the credit reporting that is dealt with, not the debt item itself. The debt is still owed. Can a debt collector still collect on it? Absolutely. It's a free country. You can collect on debt as long as you want, indefinitely. Of course, there are statute limitations for states. For example, Texas is 4 years. What that means is that's just the period of time a debt collector has the ability to pursue litigation as an avenue to collect an uncollectible debt. After that, it's outside the statute of limitation. But they can still pursue collection efforts indefinitely if they wanted to. Do most debt collectors want to? At some point, sometime, I mean, they run it like a business. At some point, sometime, a debt that's 6, 7 years old or 10 years old is not that fruitful, right? The efforts, the return on investment may not actually be there. And so that's why you see heavier debt collection like in the first 4 years, especially because they have that statute of limitation to back them up as an avenue if they need to pursue litigation to collect an uncollectible debt. But for the most part, after 4 years, you'll see collection agencies not be as aggressive on their collection efforts. Doesn't mean that they can't, continue collection efforts. They certainly still can. But that just goes to show that, at a certain point in time, the efforts to try to collect it, that may not actually be there.